1929. The financial house of cards collapses, and the overinflated stock market plunges into a Great Depression. A financial panic grips the world. For the majority, it means the interminable line outside factory gates, desperately hoping for a job that rarely comes. It means hunger and the march of the unemployed in the nation's capital. With acute domestic problems, America would now isolate herself more than ever from the international scene. It started in America, but practically overnight an economic blizzard swept the world. In Japan, France, Britain, always the unemployed, the soup kitchens, the grinding poverty, and the despair.
Hello everyone, and welcome to the first installment of our new television series, Exploring Financial Crisis. Today's episode will cover the Great Depression of the 1930s and the credit crisis of 2008. Before we begin, let me introduce our resident experts on the two crises, Heather and Arjun.
Thank you, Oz.
Thank you. As the housing market boomed, the demand for houses and hence mortgage loans by the American population increased. Investment banks, ever the pioneers of financial engineering, combined these mortgage loans into securities known as collateralized debt obligations or CDOs and sold the safest tranches to investors who were in search of high returns. Investment banks would pressure credit rating agencies such as Moody's and S&P to give these mortgage-backed securities or MBSs an inaccurately high rating, using their client-seller relationships as incentives. The proliferation of MBSs was made possible by the blurring of the lines between traditional commercial and investment banking activities by the Gramm-Leach-Bliley Act of 1999. Now, originally the homeowners being offered mortgages were carefully selected, but as the demand for CDOs increased, loans were offered to people who were not exactly creditworthy.
Okay, now please talk us through what came next or how the bubble began to burst.
Interest rates began rising in 2006, which led to defaults on mortgage payments and resulted in property foreclosures. This caused the housing bubble to finally burst, which sent homeowners' equity crashing. Since so many institutions had kept significant portions of the now worthless CDOs on their balance sheets, it became very difficult to accurately value the creditworthiness of fellow banks. This effectively caused a breakdown of trust between banks and hence overnight interbank lending. Also, many banks had over-leveraged themselves, which led to additional contractions of the external money supply. Due to the loss of confidence in the markets, widespread bank runs were made by depositors, which exacerbated the liquidity crisis. Finally, as you all know, multiple financial institutions failed in the United States and in Europe, and credit availability was reduced all over the world.
And what did this lead to?
Well, simply put, Oz, significant disruption in the flow of credit to businesses and consumers around the world. The US entered a deep recession with nearly 9 million jobs lost during 2008 and 2009. US housing prices fell nearly 30% on average, and the US stock market fell approximately 50% by early 2009. Europe to this day continues to struggle with its own economic crises, elevated unemployment, and banking impairments.
Thank you so much, Arjo, for the concise yet thorough analysis of the credit crisis. And now we should discuss the causes of the stock market crash in 1929 and the subsequent depression that affected the US and many parts of the Western world. Heather, who has been chomping at the bit to give us a brief synopsis of the Great Depression, will take us on this journey.
Indeed, I have. Many different theories have been suggested over the past decades about the causes of the Great Depression, and a concrete consensus is still to be reached. First, I'd just like to run over the numbers. In the decade that followed the crisis, personal income, tax revenue, profits and prices dropped, while international trade plunged by more than 50%. Unemployment in the US rose to 25%, and in some countries rose as high as 33%. Investment came to a halt, construction work stagnated, and crop prices fell by about 60%. Regions that were dependent on primary sector industries such as cash cropping, mining, and logging suffered the most. The stock market crash on Black Tuesday is generally regarded as the starting point of the Great Depression. Stock prices had risen throughout the 1920s. Seeing this, many people were encouraged to invest in stocks, which reinforced the economic bubble. This speculation was aided by the massive increase in margin buying, which can be seen by the fact that $8.5 billion had been loaned out by 1929, which was more than the quantity of money in the United States at that time. As a result, the stock market crash was imminent at this time, and it finally came on October 29, 1929, when 16 million shares were traded and the Dow Jones fell by 12%.
But how did this stock market crash cause such a long drawn out recession that lasted for 4 years?
To answer that question, we will have to consider the background behind the Great Depression in detail. The first 3 decades of the 20th century had seen technological innovations such as electrification, mass production, and the increasing motorization of transport and farm machinery. The resultant rapid growth in productivity meant there was a lot of excess production capacity, with falling prices, factory closures, and massive layoffs of workers who were now deemed to be surplus to requirements. This productivity shock is one of the underlying reasons behind the Great Depression. Another related point also concerns productivity growth, and that is the increasing divide between the rich and the poor in pre-Depression America. Proponents of this theory suggest that wages had increased at a lower rate than productivity, which meant that the economy produced more goods than consumers could purchase. Instead, most of the benefit of this increased productivity went into the profits of the industrialists, and subsequently into the stock market bubble. Unequal distribution of wealth meant that there was insufficient consumer demand in the market, which led to the economic recession.
Okay, so apart from the productivity shock and its effect on income disparity, could you explain on other causes that triggered Great Depression?
Some economists have suggested that the decision of the Western nations to return to the gold standard after World War I also led to the Great Depression. Accordingly, monetary policy was put into a deflationary setting, which proved particularly hard on some sectors of the economy, such as agriculture. Commodity prices fell in real terms, while the real liability of debt rose. So sectors which are deeply in debt or rely heavily on loans for financing were hit hard. This obviously exacerbated the effects of the recession.
I agree, but could you please elaborate on the significance of this debt problem that you just mentioned?
Total debt to GDP levels in the US reached a high of just under 300% by the time of the Depression. When the market fell, brokers called in these loans which could not be paid back. Banks began to fail as debtors defaulted on debt, and depositors attempted to withdraw their deposits en masse, triggering multiple bank runs. Bank failures led to the loss of billions of dollars in assets.
So were the banks to blame for not maintaining enough reserves to handle withdrawal requests?
Without a doubt, absolutely. Some of the nation's largest banks were acting in a very unsafe manner and were investing heavily in the stock market or making risky loans. The banking system was not at all well prepared to absorb the shock of a major recession. They also failed to predict that deflation had increased real interest rates and were caught completely off guard when their debtors started defaulting because of higher real interest rates.
Okay, I understand the reasons behind the Great Depression within the United States, but I still do not quite understand how this domestic crisis became so international and affected most of European countries at the time to such a large extent.
That is a very good question, but I can answer it in one word: protectionism. Let me elaborate. Many governments became cautious after the events of 1929 and from 1930 began pursuing protectionist policies. All sorts of tariffs, quotas, and exchange controls were imposed. A prime example of this is the Smoot-Hawley Tariff Act of 1930. These negative policies resulted in a complete breakdown of international trade, and instead of alleviating it, actually worsened the depression. General economic activity slowed considerably, and US exports and imports fell by over 60%. Many American banks had extended large loans to cash-strapped European nations after World War I. When high US tariffs were imposed on imported goods, the European nations began to collectively default on these loans. After the stock market crash of 1929, American investors tried to get their loans repaid, which further depressed the European economy.
Thank you, Heather, for your summary of the causes behind the Great Depression. Now that we have introduced both crises in details, I would like to move towards a detailed comparison of the causes behind the crisis. I've noticed that there was an asset bubble burst immediately before the crisis in both occasions. Can you elaborate on this, Arjun?
Oh, indeed. Housing asset prices had risen continuously for over 30 years, as I mentioned earlier, before the bubble burst in 2006. There were excessive capital inflows in the US housing market due to the withdrawal of funds from the emerging Asian markets following the Asian financial crisis of 97-98 and the savings glut in China, Japan and Germany. This led to lowering of interest rates and increase in housing market prices. The practice of issuing mortgage-backed securities or MBSs was justified by the assumption that the housing market would continue to rise in the future, and hence the burst of the bubble can be considered the singular factor that led to US financial institutions falling like a stack of dominoes, as we've seen.
Similarly, in the decade before the Depression, real estate and stock prices had risen continuously. There was excessive euphoria among investors, and the price-to-earnings ratio was at an inconceivable 32.6 times. For both crises, it has been observed empirically that excessive capital inflow into the United States fueled asset bubbles, whose subsequent burst led to the beginning of the crisis.
From your discussion, I've observed that there were multiple bank failures and company bankruptcies during the two crises. This led to decreased confidence and banks assumed a very defensive posture. Interbank lending dried up, which affected trade and investment greatly. In response to this, how effective were the government's response?
Well, I'd like to talk about this first. Widely respected banks like Lehman Brothers and Washington Mutual were allowed to fail by the Fed and the Treasury in what is considered to be a show of reassurance that taxpayer bailouts would not be undertaken. However, after some initial hesitation and the fact that these moves backfired, the government realized that the global financial system was at risk and introduced the TARP and the PSFFI bill, which spent hundreds of billions of...
So as I understand, unemployment during the Great Depression reached unforeseen levels and GDP decreased considerably. Can you give us more information on this, Heather?
Unemployment peaked at 25%, while real GDP plunged 26.6% from 1929 to 1933. Living standards diminished to horrifying extents.
Now, undoubtedly, I'm not taking anything away from the fact that the Depression was one of America's darkest hours. However, we cannot underestimate the harm caused by the financial crisis in 2008. Although the official unemployment rate was measured at 10%, a more sensible approach would be to consider underemployment levels instead of employment, and underemployment levels went up to as much as 20%.
Okay, it would now be interesting to consider for a moment the changes that were made after the two crises. Arjo, let us get started with you.
The financial crisis triggered intense regulation of US financial markets. Banks were subjected to stress tests and the capital requirements were thoroughly reevaluated. The Dodd-Frank Wall Street Reform and Consumer Protection Act was passed on 21st July 2010 and mainly aims to improve accountability and transparency in the financial system of the United States. One of its main provisions, the Volcker Rule, seeks to prevent depository institutions from conducting proprietary trading.
In a very similar attempt to regulate banking activities and ensure the stability of the financial system, the Banking Act of 1933 was enacted towards the end of the Depression. It imposed several banking reforms. However, its most famous provision was the four-part Glass-Steagall Act, which can be compared to the Volcker Rule for its separation of commercial and investment banking activities. It is no surprise that the financial crisis of 2008 occurred so soon after the provisions of the Glass-Steagall Act were overturned by the Gramm-Leach-Bliley Act of 1999 that was touched upon earlier.
Unfortunately, this is all we have for today. Before we go, can you please summarize our discussions today in a simple statement?
Certainly. On behalf of Heather, I would like to say that we hope that our discussions today have showed that the biggest banking and financial crises can all be traced back to three main factors. And these factors are credit surpluses, capital inflows and asset price bubbles. When the bubbles burst, the repercussions are far-reaching and usually damning. This is the lesson that can be learned from the comparison of any crisis.
Thank you all for having us on the show.
Yes, it was a pleasure. Thank you.
The pleasure was ours. Thank you.
Good.